Welcome to the ultimate financial face-off, real estate versus index funds. We're going to break down the 20-year showdown between two common investment paths. Jake and Marcus both believe they made the smarter move, but one forgot to count the hours, and the other forgot to count the zeros. We'll reveal the shocking difference over 2 decades. Let's set the stage fairly. Jake and Marcus share the same starting point, $50,000 saved, $55,000 annual income, same age, and same city. Only their investment choice differs. Jake uses his $50,000 for a 20% down payment on a $250,000 rental house. He takes out a 30-year mortgage at 7% interest, resulting in a $1,330 monthly payment. He finds a tenant paying $1,800 a month. On paper, before any expenses, Jake instantly sees $470 in monthly cash flow. He feels like a genius with instant profit. Marcus takes his $50,000 and quietly invests it all into a total stock market index fund. He adds an automatic $300 investment every month, then does absolutely nothing else. Marcus uses no leverage, deals with no tenants, and has no property. Day 1. Jake has a house and a story. Marcus has just a confirmation email. For the first few years, Jake is winning emotionally due to social validation. His friends ask about his property. Marcus's friends don't ask anything about his boring index funds. By year 3, Jake has collected about $17,000 in gross cash flow after mortgage payments. This sounds great, but it's only gross cash flow. The reality of landlording hits hard. You must account for property taxes, insurance, major repairs like water heaters and roof leaks, and the cost of vacancy and turnover. After factoring in all real costs, Jake's actual profit over 3 years is shockingly low, dropping to between $2,000 and $4,000, and this still doesn't factor in the value of his time. Meanwhile, Marcus, with his initial $50,000 and $300 monthly investment, is now sitting on approximately $76,000 after 3 years, with zero time, stress, or calls. Jake still has one massive advantage: leverage. His $250,000 asset has appreciated, and his equity, built partly with the bank's money, is a true wealth builder. Most people stop their analysis right here. They see rent, appreciation, and leverage, and conclude that real estate is the clear winner. But they are missing what comes next. Stay tuned for the second part of our series, where we fast forward 20 years to reveal the final net worth of Jake and Marcus. The difference will make your stomach drop. Welcome to the ultimate investment face-off. Real estate versus stocks. We're breaking down the 20-year net worth showdown. Jake bought a rental property. Marcus invested in the stock market. Both started 20 years ago. Who came out ahead? After 20 years, Jake's property value has soared to nearly $500,000, leaving him with an impressive equity of $400,000 to $500,000. However, after accounting for maintenance, repairs, vacancies, taxes, and a major renovation, Jake's actual profit from cash flow is only between $40,000 and $80,000. Marcus, with a 10% average return and $300 monthly contributions, saw his portfolio grow to between $420,000 and $460,000, largely through pure compound growth. The surprising truth? Their net worths are almost identical, both sitting in the $400,000 to $500,000 range. But the path they took was dramatically different. Jake worked for his wealth. He dealt with stress, massive time commitment, and the risk of having all his wealth tied up in one illiquid asset. Marcus waited for his wealth. He faced market volatility but enjoyed liquidity, freedom, and simplicity. No dealing with tenants or 2 a.m. maintenance calls. The math changes if Marcus increased his investment from $300 to $500 a month. His portfolio jumps to up to $600,000. Proving that in stocks, more money means exponentially more compound growth. For Jake to achieve similar growth, he'd need to buy another property, take another loan, and manage more tenants, effectively doubling his workload and risk. But stocks aren't perfect. Market crashes are brutal, leading to emotional pressure and panic selling, and they offer generally low monthly cash flow compared to real estate. Real estate offers powerful leverage, using $50,000 to control a $250,000 asset, and significant tax advantages like depreciation, which stocks simply don't provide. The conclusion is that real estate can outperform stocks, but only in specific situations, with strong rent-to-price ratios, smart management systems, and a solid long-term strategy. Stocks win when you are consistent, avoid emotional decisions during volatility, and continually increase your contributions over time. The biggest trap is making financial decisions based on partial information. Always run the full numbers, including time, stress, risk, and opportunity cost, to find the answer that truly matters for your wealth. Everyone talks about the big rent check, but what about what comes out of it? Let's dive into the often overlooked costs of real estate investing versus passive investment. That $1,800 rent check you see online, it's not all profit. In fact, most of it is already spoken for. First, factor in vacancy. Even a good rental sits empty about 1 month a year, meaning one full mortgage payment with no income. Then there's the cost of cleaning, repairs, and listing when tenants leave. The general rule for maintenance is to budget 1 to 2% of the property value annually. For a $250,000 house, that's $2,500 to $5,000 a year for things like leaking faucets or broken switches. Then you have the big, inevitable capital expenditures. Things like replacing a roof, furnace, or water heater can cost anywhere from $5,000 to $15,000 when they hit, and you can't delay them. If you're not saving monthly for these capital expenditures, you're not running a business. You're gambling with your investment. Property management costs 8 to 10% of your rent, or about $150 to $180 per month. If you manage it yourself, you're essentially working a part-time job for free. And the risk nobody wants to mention: bad tenants. A single bad tenant who stops paying can cost you 3 to 6 months of lost rent and hefty legal fees, potentially wiping out a whole year of profit. By year 5, Jake is deep in reality. He's dealt with roof replacement, plumbing issues, and multiple vacant months. The expenses hit hard. Even with increased rent, Jake's real return after all costs averages around 3 to 5% annually. Not bad, but far from the 15 to 20% returns often bragged about. Meanwhile, Marcus, who chose a diversified investment portfolio, has grown his portfolio to between $135,000 and $150,000 by year 7, all with zero effort. At this stage, Marcus's growth is no longer coming primarily from his contributions, but from his gains. Compounding has kicked in, starting slow but accelerating dramatically. By year 10, Jake's property equity is roughly $170,000 to $184,000, while Marcus's portfolio is close behind at $165,000 to $180,000. Surprisingly close destinations, but look deeper. Jake took on massive debt and spent hundreds of hours managing a concentrated asset. Marcus diversified, took 0 calls, and lost 0 sleep. Same destination, very different journey. What happens when you stop thinking real estate versus stocks and start thinking, how do I use both? The smartest investors operate not in extremes, but in balance, strategically utilizing both stocks and real estate. Imagine Marcus, who begins by consistently investing in index funds, allowing his portfolio to grow steadily through compounding. After his portfolio reaches a significant amount, say $150,000, Marcus uses a portion of those funds as a down payment on a rental property. Now Marcus has 2 powerful wealth engines. His stocks continue compounding silently in the background, growing his net worth. Simultaneously, his real estate investment generates consistent cash flow, providing immediate income. Stocks offer liquidity, 0 effort, and pure compounding. However, they typically lack strong cash flow and the use of leverage. Real estate provides cash flow, leverage, and tax advantages, but its drawbacks include lack of simplicity, time freedom, and diversification. Together, these assets fix each other's weaknesses. When the stock market drops, your rental income provides stability. When property is vacant, your stock investments are still growing. As Marcus's income grows, he can easily increase stock contributions. But for real estate, he deploys capital strategically only when the right deal appears, not constantly. In this balanced approach, stocks provide consistency for steady growth, while real estate provides the opportunities for major capital deployment. Compare this to Jake, who rushed into real estate too early, tying up every dollar without stable income or financial discipline, and ultimately getting stuck. The smarter path is to build your base first, ensure an emergency fund, maintain consistent index fund investing, and establish financial discipline. Remember this truth: wealth is built by staying consistent, avoiding big mistakes, and playing the long-term game. Instead of asking what's better, ask yourself, what fits my life right now? And what can I sustain for the next 10 to 20 years?